Have you ever been in a relationship where timing was everything? Whether it's deciding when to take things to the next level or knowing when to give it some space, timing can make or break the connection. Well, guys, the same goes for real estate investments. Welcome back to ECMP Studios. I'm Amit Grover, and today we're going to focus on the crucial aspect of timing the market, specifically when to diversify your real estate investments. Think of it as finding the perfect moment to take your investment relationship to the next level. Diversifying at the right time can significantly enhance your portfolio's resilience and profitability. Now, let's explore some key indicators and strategies to help you decide the optimal timing for diversification. First, market saturation. Now, imagine you're in a relationship that's starting to feel a little too comfortable. Things are stable, but maybe a little bit stagnant. That's market saturation. When yields in your current investment areas begin to flatten or decrease, it might be time to diversify into new geographic areas or different types of real estate. It's like exploring new horizons in a relationship to keep things exciting and growing. Second, economic indicators. Just as you might watch for signs that your partner's ready for a bigger commitment, you should keep a close eye on economic indicators like GDP growth, employment data, and consumer spending trends. A strengthening economy can be a green light for diversification, offering opportunities for expansion as market demand increases. It's like knowing the perfect moment to pop the big question because everything else in life is aligning. Third, interest rate trends. Interest rates are like the financial temperature in your relationship. When they are low, it's easier to take on new commitments, like financing new properties, because the cost of borrowing is cheaper. But when the rates rise, it's like the cost of everything in your relationship going up, making you more cautious of expanding too quickly. Timing your diversification around interest rate trends can help maximize returns and manage risks. Fourth, emerging trends. In relationships, sometimes you notice changes. Maybe your partner has developed a new interest or shift in lifestyle. In real estate, these shifts are emerging trends, such as demographic changes, technological advancements, or even new consumer behavior. By diversifying early into areas influenced by these trends, you position your portfolio to benefit from early growth stages, much like embracing a new chapter in your relationship. Fifth, risk assessment. You have to continually assess the risk profile of your existing investments, just like you would periodically evaluate how things are going in your relationship. If certain assets become too risky, whether due to market volatility, economic downturns, or even other factors, it may be wise to diversify into safer assets. It's like deciding when to have the tough conversation to ensure relationships stay strong and healthy. Sixth, real estate cycles. Real estate markets are cyclical, just like relationships have their phases. Knowing where you are in the cycle, whether it's a time of growth, stability, or downturn, can help you decide when to diversify. Diversifying at the beginning of a growth phase can maximize your investment gains, while diversifying during a downturn might be aimed at preservation and finding counter-cyclical opportunities. Now, let's reflect on your current portfolio. Are there signs that it's time to diversify? How can adjusting your investment timing improve your returns? Much like making well-timed decisions strengthens a relationship. Next time, we're going to conclude our series by discussing exit strategies for diversified real estate investments, where we will talk about how to gracefully and profitably exit from your investment positions, kind of like knowing when it's time to move on in a relationship. And remember, if you haven't already, hit that like button, subscribe, and turn on notifications for ECMP Studios. Let's keep learning, keep planning, and as always, keep it real. Stay